Welcome to Coleman Certified SBA Loan Training Office Hours with Lance Sexton. Lance, a little different format, but I like it. I think you like it also.
I do too. It's opportunity. There's so many different areas of SBA lending that cross one another that, closers, originators, servicers, and liquidators can all benefit from the discussion. And I think we have some fun topics for today.
And SBA 1 soon. We're going to do SBA 1 starting in July. Hey, first shout-outs. This is technically week 8 for our servicers, Lance?
Yes, it is.
So congratulations to Kevin, Stacy, Brent, Chad, Liz, the 2 Lisas, Ken, Jeffrey, Frank, David, Cherie, Melanie, JJ, and Ashley for completing that. Let's start off with that, Lance. You redid week 8. I know down there in Arkansas. Tell us what was just the recap of the servicing course.
Well, the redo on week 8 mostly talked about the changes in the SOP. Of course, the 5057-2 came out. It came out late November. It was effective December 1, and I wanted to make sure in the servicing course that we spent time talking about the changes in the 5057. I don't know when the next change, but with some of the proposed legislation that's on the table.
We're going to talk about that. We're
probably going to see a 5057-3 later this year. So, but we covered the new servicing SOP and the changes that are inside.
Let's get to the email questions. As you know, there's a couple ways to ask questions. You can do it during this session. Send us an email, Lance, and get back to you. But the first question is from Laura. And the lender will be uploading its credit memorandum to SBA 1. There are many credit analysis questions asked by the software. Is it acceptable to SBA to input C, lender's credit memo?
Bob, she asked the question, and I answered the question, and then I had a loan I was putting in, and I decided to go ahead and test it and see if my response was correct. And it is, once you get through putting in the basic eligibility information and the loan structure information, you come to a point where SBA 1 will create a credit memo for you now, Bob, and we used to think that it won't, but it actually will. And there is a series of questions related to the credit memo, and you can take the option of either using your own lender's credit memo, or you can let SBA 1 create the credit memo for you. I always choose the option of using my own lender's credit memo. Typically, in the past, I've answered all the questions, but I went ahead and did C credit memo. And I went to the documents section and drug my lender's credit memo like I always do into SBA 1, and it was fine. It worked fine. It processed fine. So if you're uploading your lender's credit memo, I think it's perfectly acceptable. And you can't leave those questions blank, Bob, or it'll stop. You've got to put something in there. So putting C lender's credit memo will make it move forward, and it works.
Best practice? Is there either one's fine, or do you think we should?
I've played around with it because I've actually generated SBA's credit memo. One thing that I'll share with you as a participant bank, the SBA credit memo does touch base with all the things that SBA is looking for in your credit memorandum. And sometimes a lender's credit memo, and an example, Bob, and we're going to talk about this in a second, the credit elsewhere test. Your SBA credit memorandum that's generated from SBA 1 clearly has a section on that and would meet SBA's requirements for proof. So if your credit memo is solid and it touches base with all the requirements that the SOP 5010-5H indicates, then just upload yours. But if you feel like your credit memo is not touching base with all those, the SBA 1 generated credit memo is a pretty good credit memo.
I want to take some time and go over what the class is. There's huge news coming out this week. First, SBA 504 refi has been announced. It was published in the Federal Register. Beginning June 24th, you'll be able to process these loans through Citrus Heights. Cash out up to 75% loan to value. We can go up to 90% on a refinance. 504 refi refi projects must adhere to. That's actually wrong. It does not need job creation and retention requirements. That has been waived. The refinance loans cannot be delinquent for the past 12 months. You must provide a transcript. We cannot take out government debt, and the debt has to be on the books for 2 years. Again, we need the refi 504 program occupancy of 51%. Lance, are you going to be using this in your institution?
We do not get deeply involved in 504 lending, although I think I'll just share with you, Bob, I was working liquidating a bank that had a substantial portfolio of 504 first mortgage loans. And in looking at it from a liquidation perspective, 504 loans, when you're the first mortgage lender, there are a very small number of circumstances where the first mortgage lender does not come out whole. So this is an excellent opportunity, if you are involved in this, for you to look at potentially refinancing some commercial real estate loans to small businesses. And I feel like it's a very safe, I'm not going to say risk-free, but relatively risk-free type of commercial real estate lending.
And you can refinance your same institution debt.
Absolutely.
If there's
it's got to meet the SOP requirements, but yes.
Yeah, you can do that. And again, these loans are not approved on a PLP basis, as in a 7A. Everything has to be blessed by SBA. But it's another great product in your toolbox. Huge news yesterday, the Senate held a hearing. They introduced what they call the Small Business Lending Oversight Act of 2016. And we could talk to this for an hour. I'm going to be very brief. It is a game changer in a lot of areas. The big change is the SBA now has the ability to fine you up to $250,000. Now, someone asked me, is that per occurrence, per loan? I don't know. It's still how it works is they pass the bill and then SBA gets to write the regs. But this is the big thing, Lance. If you fail to document credit elsewhere, you can be slapped with a $250,000 fine, Lance.
Well, I think, and we talked about this a couple times, Bob, I'm not real sure why it started with the discussion about the credit elsewhere rule, but I think many of the lenders need to do what I did. I took the language from the proposed legislation. I developed a standard memo for credit elsewhere, and I'm going to insert SBA loan number and SBA loan name. I'm going to make sure it's in every loan that we do. It seems to me credit elsewhere is an eligibility issue, Bob, and SBA could deny your guarantee. So are they telling me they're going to deny my guarantee and then tag me with a fine?
And suspend your PLP. They're going to do all three.
I think the lesson to be learned is make sure your lending staff, your origination and closing staff, which we have people that are doing this, are well trained and do things according to the SOP, and these fines will not be a significant issue. Now,
Lance, you made an important point. This is for the rogue lender. This is for the BLXs of the past, and they're not going to be slapping fines on the everyday lender who has a hiccup now and then. That is not the intent. The intent is they want to have some heavy-handed options to go after what they perceive are rogue lenders.
Bob, it's kind of like when I played basketball in high school and we carried food on the bus and the coach decided to make us run afterwards. Well, two people on a team of 20 players broke the rules. Everybody had to run, and that's what I see this legislation as. There are some SBA lenders who may not be following the spirit of the SOP, and they're looking to penalize everybody because two people broke, a small group are not following the rules.
I think we missed a slide in here in an oversight, Joseph. Go to the next. Yeah, okay, there it is. And, of course, now SBA has the ability to suspend PLP for 90 days, 180 days, whatever. Right now, the nuclear option is you're either a lender or we're going to pull the whole thing. So this gives them a little bit more oversight.
Well, and some of the other things, Bob, and I'm sure this slide's going to come up, they're adjusting the point where they start sharing in the premium income?
Now hold on. The slide's not up yet. We'll
Oh,
get
I'm
to that.
sorry, Bob.
To pay for this, 3 basis points, which, well, what's 3 basis points? Well, on a $50 million portfolio, it's $15,000. So it can add up.
Well, and I think there'll be a lot of lender pushback on that, Bob. It's much like the old on-site reviews that SBA did, and there was this ridiculous charge for it, and lenders pushed back, and all of a sudden SBA found a different way to do it. And I think that may occur on this.
And this is what you're talking about, Lance. This is all proposed legislation, but however, it is bipartisan. Some form of this will definitely pass, if not all of it. Secondary market, the tax will be lowered from 110 to 108 on the split to help fund this oversight. I wrote an article yesterday where I said that's grossly unfair to the community banks, the credit unions, the small lenders, CDCs, the Main Street, the Wall Street banks are exempt from that because they don't need the secondary market. So we'll see. I think it's unfair. It's a tax. And I said it's a bizarre tax. The Small Business Committee of the Senate has imposed a bizarre tax on small business again. You know, these banks, CDCs, they're small businesses, Lance.
Well, and I believe, Bob, I'm right in line with you. I think that this affects the community bank. It doesn't affect the $50 billion bank the way it affects a bank like mine. And I have a return on equity model that we look at when considering selling one on the secondary market. Most community banks portfolio the bulk of their loans anyway. They'll sell one periodically to get a jolt in income, non-interest income. When you look at the return on equity model, Bob, it's certainly the break-even point between keeping one in your portfolio or selling one on the secondary market. Certainly will change if this becomes law.
The second sentence is a little obscure, but it's a very important change. In the past, lenders had to retain 5% of the loan. They could sell off the guarantee, say 70%, and they could sell off 25% of the unguaranteed portion. Now they're saying, no, you need to retain 15%, which, Lance, that's, I don't want to get into a Dodd-Frank discussion, but that's more than what Dodd-Frank requires.
I agree. And, Bob, again, as a bank, we don't sell more than the SBA guaranteed portion, but I do know there are a lot of banks that also sell a portion of the unguaranteed part of the SBA loan. And it's an additional way to create income. And Bob, I'm an entrepreneur. I was a small business owner for 10 years, and quite frankly, I thought that's what banking was about, to make net income. And what's wrong with an SBA lending bank creating income?
Well, as you said, one person ate food on the bus, and we're all paying for it. Next slide, Joseph. Concentrations. You can't have more than 15% of your portfolio, i.e. hotels, poultry farms, in an industry. And now, if you do less than $235 million, it doesn't apply. This is for lenders who do settlement volume in excess of $235 million.
I really think this rule is intended for the very large SBA lenders that concentrate in one particular NAICS code or two.
Live Oak
Most of the participants in this program understand that the PAIR score, we have a program on the PAIR score and how that is created and how you can impact it. And one of the things that I've been doing at my bank is trying to make sure that not only do we have a variety of SBA loan sizes, for every $2 million loan, we want a $50,000 loan.
What's prudent lending, Lance? It's diversification.
That's exactly right, Bob. Prudent lending. So for most lenders, the portfolio concentration.
Yeah, but if you look at the loss ratio in Live Oak Bank's portfolio, guess what? Very minimal. Very minimal.
Yeah, almost zero.
Well, they pick good industries, dentists, vets.
Well, Bob, a lot of banks do poultry lending, and we do some at our bank. And if you look at the Coleman reports, 10-year charge-off rate on poultry loans, they're less than 1%.
They're clamping down on 100% commercial real estate financing. That cannot be more than 20% of the portfolio. I don't think anybody has too much of a problem with that. And now this one's interesting. Loans that provide financing in excess of 100% LTV will be prohibited. So anyway, as we said, these are proposed. They're not in effect. Don't lose sleep over them yet, but that's where we are. This is what Lance was talking about, credit elsewhere. Basically, the proposal is right now it's a lender certification that the lender, in the lender's opinion, that this borrower can't get credit elsewhere. Now you're shifting it to the borrower. Can the borrower get the credit? Not just the lender perceive it. Can the borrower get it? Go ahead, Lance.
My question, Bob, is will the 1919 change to reflect this? Because this might be a good thing for lenders if they change to 1919 and make the borrower certify that credit was not available elsewhere. It would be interesting if they take it off the bank and put it on the borrower. Quite frankly, Bob, when you look at these 4 areas of credit, 4 areas of credit elsewhere, these 4 are the primary reasons you use the SBA loan program anyway.
Yeah, and SBA has been wrestling with this really since the inception of the program. It's a conversation of why are we here? How many angels can dance on the head of the pin? Should SBA be picking winners and losers? The intent of the program was to get capital to Main Street, and the intent was, hey, Main Street can't get capital, so we're here to do that. And SBA Congress constantly wrestles with this. So don't worry about it, but change is a-coming. Lance, we have a question. Would you be willing to share a copy of your Credit Elsewhere memo next week?
Bob, absolutely. It's not very complicated.
Good.
I don't think SBA expects you to
Marshall.
write a 20-page memo on this. I think SBA just wants to know that you've actually thought about it. So absolutely, Bob, if you'll remind me, I'll send you a copy of what I'm going to use. I save things like this, and I replicate it and use it on every loan.
I would not get, thank you, Lance, I appreciate that. Where lenders have been criticized, Marcia, in the past is where they put, well, first of all, they ignore it, so that will be dinged. But the other one is the lender will put in the credit memo, credit is unavailable elsewhere. I think did that I think we all did that 30 years ago and said, no, you can't do that anymore. So now, if you read, as Lance mentioned, the 1920 also, it says document the credit elsewhere. So now that we're being very specific, and we'll spend some time on that next week, Lance.
And Bob, I want to throw out my pet peeve of the week.
So is this, wait a minute, that's not on that's not on the slide. Is this a new segment, Lance?
This is a new segment.
Lance's pet peeve of the week. Go ahead.
In processing SBA loans, I don't know if you guys have noticed, but the personal resource tests don't exist anymore. So on the SBA Form 1920, I discontinued answering that question because it
well, that was. Well, go ahead. I'll let you finish. I already know where this is going.
This week from the processing center, on 2 occasions, I got a screen out that said I didn't answer the personal resource test, and I sent an email back and I said, hey guys, that don't exist anymore. But I had to actually, Bob, print a copy of that page of the 1920, check the box, scan it, and email it to get by. Now, again, I was deputy director of SBA, and I do know that there's some things that occur that don't always make sense to us as participant banks, but that's one that's my pet peeve of the week.
Very good. We respect your time. Again, if you can, we're going to be doing this every Friday. If you miss it, we'll have it online, and you can download it and send us questions during the week. And with that, enjoy the long weekend. We'll talk to you next Friday.
Have a great weekend.